So a Monte Carlo is a simulation that financial planners will use that runs market performance through 1,000 hypothetical scenarios of different rates of returns for all the asset classes you hold. And it will plot out in confidence levels or confidence intervals what is most likely to happen. So at the very fringes, you have like, okay, at the very fringes, you have like 25% to 75%. This is going to answer your question. I apologize. This is going to sound very roundabout, but it's important. So at the very fringes, you're going to have like 25 to 75% confidence. So when you invest money, you're like, I know I'm going to have somewhere between I'm just going to make these numbers up, 1 million and 2 million. Right. So on average, running the simulation, I know I'm going to have somewhere between 1 million and 2 million. As the confidence levels, get narrowed, this might be, or maybe we call this like 90, we call this 10, we call this 25 to 75, and then 50 would be the median, not dollars percent. So when you use a Monte Carlo simulation, you are plotting the likelihood of any given outcome. What we find is that equities, because they have very volatile pricing, the more equities you have in a portfolio, the wider the largest confidence intervals become. Because there's a likelihood that 20 years from now, the equity market's going to be down dramatically, which would lead to this negative. But it's also likely that it could be up exponentially, which would lead to this positive. When you add fixed income into a portfolio, what I would say that it does is it tightens the confidence intervals so that the value is more certain than it would be with strictly equities. So basically, the more fixed income you have, the more likely you are to know exactly what dollar amount you're going to have because the coupons are fixed and they're relatively easy to value and to forecast. So when it comes to, okay, well, great, that's all great in theory. Now, does a young person own equities or bonds and how much of each? The question becomes, what is your risk tolerance and how much deviation in the worst case scenario and the best case scenario are you willing to assume? Right? How much of that risk are you willing to assume? We would say that adding fixed income narrows the range of possible outcomes. Right? Mathematically, that's what it does. So when you're deciding for your own portfolio, okay, well, do I want to own any fixed income? What you're going to look at, like for example, what I would look at in my own situation is if I own no bonds, how drastic do the positive and negatives get? How drastic do these ends get? And if I add bonds, can I narrow them in while still allowing for growth, but kind of narrowing in the possible outcomes to be closer to the average? So I have an idea that like I'm probably going to have about this much money.